Hello and welcome to MF Corner. It's a special edition today. I'm Sonal Bhutra in the Mumbai studio. Today we discuss something that we've been discussing for a while and it's very topical. We'll put focus on the recent boom in the Chinese markets, the stellar rally that we've seen. But how can investors sitting in India can play it via the mutual fund route? Something that a lot of you have been writing in and talking about as well. So we'll get in our guest to answer that for you. Later on the show, if we do get time from this interesting topic, we will discuss the recent SEBI norms, including the approval to introduce a new asset class to bridge the gap between mutual funds and PMS. But all this and a lot more with our two special guests on the show today, Radhika Gupta of Edelweiss AMC and Feroz Aziz of Anand Rathi Wealth. Radhika and Feroz, thank you so much for joining in today. And you know, this is a topic which everyone's been talking about, so it's good to get in your opinion as well. But lady, let me start with you. Radhika, what is the view now? Is it the time fund managers, AMCs, they will start looking at Chinese markets for investments? Or do we need more in terms of a constructive view or in terms of actions before a view can be made on these markets?
So good to be here. Happy Friday. And look, we have had perhaps the oldest China product in the market for Indian investors, Edelweiss Greater China Fund. We've had it since 2017 and it used to exist before. So I have seen this Chinese story from a India investment point of view over the last 6-7 years go through various ups and downs. And I keep joking with my team that 2 weeks ago, there was very little action in the fund except, selective value investors. So selective value investors knew that there was an interesting play. Cut to the week that's just come by, there's been a frenzy of activity in the China fund from our own investors and, lots of questions, lots of flows. So I think that the situation has just turned in the last 2 weeks. Now, I think our summary of the situation is this, and our advice to all investors is this, that, what is happening in China? The valuation story is supportive. It has been supportive for a year. There was a slowdown in the economy and a slowdown in consumption post-COVID. There were certain actions that governments took that made people uncomfortable. Now there is a sense that the government wants to do a lot to stimulate consumption, to revive the real estate sector, and to give a little bit of boost to equity markets. And this hope of a turnaround, combined with the fact that valuations are doing well, bodes well. We still tell people, however, that don't try to do a short-term tactical trade on China because, you've had these rallies before. You had this rally 3-4 months ago and then it fizzled out. If you're trying to be a long-term investor in China, it's a great story. It's finally the second largest market and it's available at very attractive valuation. So we really are trying to orient our investors towards long-term here because we've seen this cookie.
Oh yes, and there's so much excitement suddenly because it's not been doing so well for such a long time. Let me get in Feroz in the conversation as well. Feroz, first, what is the idea on Chinese markets and how do we compare it with India now? Because there's suddenly the China versus India debate as well.
Yes, Sonal, good afternoon and good afternoon, Radhika. Firstly, point is that China and India have at least from an Indian standpoint, competing with each other. Yeah. From a global standpoint, India and China have not been able to compete. For somebody who's outside India, who does not have the India bias, they don't see India and China as the same. We do because we stay in India. But I think Chinese have reminded us about what they did in 2008 with this new stimulus. They had done almost about $570 billion of stimulus way back in 2008, which put them in a trajectory of a great growth for almost a decade and more. Almost 15 years. And they didn't go through a recession, which the world went through. So I think it's a reminder of that. So like Radhika said, if you're taking a structural call on China, then using one of these funds to get into a Chinese market with a fund manager's eye on it is a great strategy. Point two, India and China. I think India, FIIs, if you look at the numbers of FIIs, you'll be disappointed of how FIIs have pulled out from India. Yeah. If you look at the full calendar year, you have almost about $22 billion, which is 1,65,000 crores, exited till the September end. And they have been light on India ever since January. On the election day, FII index futures, election counting day, was at short 88%. Just last week, it crossed 80% on the long side. So point I'm trying to make is FIIs have not been so bullish India. They've been very bullish India small cap. This is one great trend which people are missing. Indians Indian stocks which FIIs are buying are the small cap ones. So to answer your pointed question, I'm not too worried whether FIIs will pull out of India to invest in China. They've been pulling out either way.
Okay. And yesterday we saw 12,000 crore rupees, and that has been the single biggest number that we've seen in last 4 years. So you're right, that has been happening for a while. But Radhika, let me get you in the conversation. Now that you're saying it's not a tactical play, investors can look at China from a long-term perspective, valuations are supportive. What are some of the investment opportunities available in the Chinese markets currently, some themes that they can play on?
So if I look at the way we structure our fund, and there are multiple China products out there in the market, but we run, I think, the equivalent of a flexi cap fund for China. There's been a little bit of sector rotation in how we think about the fund. So a couple of the core themes that exist today, one is technology. So a number of companies in China are large beneficiaries of what is going on in AI. So moving from traditional old tech to some of these companies is interesting. The second theme that we're looking at is insurance. Insurance as a sector is poised for a turnaround. Third theme that we're looking at is this whole thesis around carbon neutrality. Solar is a big emerging theme in China. Over the last few years, China has also emerged as a leader in the whole EV race. So that becomes part of your carbon neutrality theme. And I think fourth, related to this stimulus, there is an expectation of a revival in the real estate sector. And real estate, when there is a revival in real estate, it also accounts for a material part of the wealth of a Chinese person. So indirect plays on real estate, similar to how we look at in India, particularly home improvement, home building, all of these are in some sense consumption-oriented plays. But a play on the revival of consumption, given all the kind of stimulus activity that is happening or is expected in China, these are some of the themes that we're positive on. Themes that we're less positive on or underweight on in this particular fund are financials and banking in particular.
Okay, financials and banking. That's Radhika's view. That's the Edelweiss AMC view. What about you, Feroz? What are some of the themes that an investor can play on when it comes to Chinese markets?
See, I think you have to play a very broader market. When you're going outside the country, I would stick to indices. Of course, the Edelweiss fund, like the Greater China Fund, has been offshore fund. It's a feeder fund. It has been in existence for more than 5-6 years. The first great part is you're discussing something, Sonal, I should compliment you, which has the worst rear view mirror. Right? Generally, when past performance is great is when these get discussed, right? Now, if you look at the Greater China Fund, for the last 3 years, it's given a compounded minus 13. So that itself implies that these are the times, the troughs to back that argument that there is value. So coming back to what themes, I would say you have ETF as one of your alternative, and you have these feeder funds also as an alternative, and you have LRS, which is the liberalized remittance scheme, as your alternative. These are your three alternatives. In my opinion, you can definitely look at the Hang Seng Index Fund, which is there. You can definitely look at the oldest Edelweiss feeder fund, because Radhika would be better poised to say how long has the feeder fund, the primary fund, been into existence and a track record. I think I would leave it to the fund manager, but I would prefer a feeder fund rather than only a domestic asset management company looking at China with fewer analysts. But if somebody is more deep-rooted there, that's much better, and that's what the feeder fund would do.
Okay. I'll come back to you if there are any specific names, themes like, EVs or something else that Radhika spoke about as well. Radhika, since we have you with us and you have a feeder fund here, that's the Edelweiss Greater China Equity Offshore Fund, you spoke about the themes that you would be bullish on or not be very overweight on as well. Can you give us more sense about the strategy of this feeder fund? Where does it invest? Which markets does it have exposure to? Is the composition now, there's a lot of activity that you're seeing in the feeder fund as well?
Absolutely. And, just to sort of emphasize Feroz's point, by the way, this feeder fund has been around, the original fund has been around since 2001. And I would repeat a point that Feroz mentioned. We don't manage the fund directly. We invest in the original JP Morgan fund. I think in this case, it's extremely important because China is a very, very nuanced market. It's not something we attempt to do as India fund managers. And our JP Morgan team, between their presence in Shanghai and Hong Kong, has 45 people on the ground looking at China. So that is extremely important. In terms of the composition of the fund is it's a greater China fund. So it's a combination of three markets: China, Hong Kong, and Taiwan. It's about 56 to 60% China at this point in time, about 10% Hong Kong, and the balance is select companies in the Taiwan area, so companies like TSMC, etc. So it's about a 50 to 60 stock fund, so very much a flexi cap fund that has the mandate to look across sectors.
Okay, so this is one of the ways, of course, how an investor can get exposure if a mutual fund investor wants an exposure to Chinese markets. So two-part question for you now, Feroz. The three ways for mutual funds to take exposure to these Chinese funds, if you can repeat that for us. And second is some of the themes that you also think could work in the Chinese markets.
Yes, sure. First, let me address that bit, because a mutual fund manager, so the three ways are, one is not a mutual fund way, which is the liberalized remittance scheme, where you and I, as Indian residents, have the right to send almost about $250,000 outside every financial year per person in a family. So that largely the ultra HNI families end up using it. That's point one. But from a mutual fund standpoint, there are some feeder funds, like Radhika said, and she emphasized that that fund has been in existence for 23 years, but the wrapper fund is there for 6 years. So it's not just 6 years track record, but you have 23 years. Now suddenly changes the entire thing, and 45 people on ground. So one are these fund of funds, the others are index funds, which are there. These are the two, in which, if I have to give you some names of the funds, there are two which stand out on China, which is the Axis Greater China Equity Fund and Edelweiss Greater China Equity Offshore Fund. These two are fund of funds, especially because of the tax change in this budget. These have become attractive. Otherwise, if I was going to pay marginal tax rate on an investment going global, so I'm taking the risk and funding the government if I'm going to just take the marginal tax rate. So that's a big advantage. If you come to the Hang Seng, there's one Hang Seng Nippon India ETF Hang Seng Bs, which are low cost and also invest in the Hang Seng Complete Index. There's also one, which is Mirai Asset Hang Seng Tech ETF. But I would definitely not recommend you to pick up only the tech stocks from Hang Seng, because you're anyways doubling up the risk if you do that. And in the LRS, of course, new energy and infrastructure and industrials is what I think I would be bullish on. If you're such a large guy that you want to remit the money offshore, and buy something domestically domiciled there, these are the two themes.
Okay, so these are the ways a mutual fund investor can go ahead. Radhika, coming on this is something that, of course, you must be getting a lot of questions about. I asked that to Feroz as well. Is it fair to have an India versus China debate first up? Does it make sense to do that? What is the idea on Indian markets right now, considering the fall that we've been seeing?
So I think yes and no to India-China debate, and it depends on the lens that you look at. As a domestic investor, your primary allocation will always be India. I think 60-70% of your allocation will be India. That's what we would recommend. That's what, most folks in the wealth industry, most advisors would recommend. And most people who are evolved investors, and I would say, again, evolved investors who are not making their first investment, would probably have 15 to 25% exposure to some kind of international products. And if you're looking for international products, then you will have US and you will have China, because these are the two largest economies. Now, from a domestic investor's point of view, some of the challenge the domestic investors have is, I've invested in a China fund, it's underperformed in India fund. And then there'll be a period where you've invested in a China fund and it's outperformed in India fund. And I keep telling people, that is diversification, and that is the meaning of diversification. If you're an Indian investor, the reason to invest in absolute, the Indian market is fantastic over 10 years. But the reason to invest in a market like US or a market like China is they perform at different times than India, and that is what diversification is. So you should look to have exposure to US and China, in my view, but you should realize that, again, these are long-term investments. These markets will have their volatility and they'll perform, and India doesn't. I think from a foreign investors' point of view, they are similar in the sense that if you're looking to allocate capital to emerging markets, there are only two markets where you can park large amounts of capital, and they are India and China. However, when I meet global investors, I think the thesis for both is very different. People see India as a great 10-year growth story with a lot of stability, strong flows, demographics, etc. People see China very differently. It's almost 15 years ahead of India in the cycle. They see it as a little bit of instability, but finally the world's second largest economy, but much cheaper valuation. So I think from a global investor's point of view, there is a little bit of a trade-off. And that's what you've seen this week. Some people are saying, I'm cutting a little bit of weight to India, adding a little bit of weight to China. I net agree with Feroz that from a flow point of view, it should not matter because India has hardly seen FII flows.
That's been the other trend that we have been talking about, this big outflow from FIIs and how DIs have been pumping in money. It's all been about the big SIP flow, right? It's a very interesting discussion, but we have to slip into a quick break, Radhika and Feroz. On the other side, we'll continue our discussion and add on the other aspects of what's happening in the mutual fund industry as well. It'll be the new SEBI announcements from its board meet and a lot more. Stay tuned. Welcome back. You're still tuned into MF Corner. We still have with us Feroz Aziz of Anand Rathi Wealth and Radhika Gupta of Edelweiss AMC. Now we are talking about something different because SEBI's new announcements, they spoke about creating a new product to bridge the gap between PMS and mutual funds. There was MF Lite framework. They also relaxed the eligibility criteria for registered investment advisors. But let's talk about the new product, the investment product. This will be under existing mutual fund framework to bridge mutual fund and PMS gap. Feroz, let me start with you. This was discussed in July as well. There's still nothing concrete finalized here. Tell us, what is it different now versus what was in July? How would it work? And what are some of the key considerations that you think the regulator should also keep in mind?
Yes, so I think, Sonal, it's a very, very progressive step. Why? Because today you have some platforms available. So if this platform was a Me Too platform, then it was a useless one. So if you look at mutual funds and PMS, these are two prominent platforms, and people use also AIF for long-only positions today. These are the three platforms. Now this becomes the fourth platform called the investment strategy or strategy ka platform, whatever they actually finally name it. In mutual funds, derivative usage is only limited to selling calls if you have the same asset. If I have a Reliance share, for example, I can sell calls of Reliance share. That's called a covered call strategy is possible. You can buy puts and buy calls. This is what is available on mutual fund currently available. Then PMSs can use derivatives only for hedging purposes is what it is mentioned. Now people might take a little more aggressive stance as a manager, but this is what is mentioned. Now, so this is very relevant because the existing platforms don't permit usage of derivatives very well. And AIF is 1 crore plus. So I'm very excited about this, point one. Point two, if the leverage ratios are reasonable, because futures in India can get you, Nifty futures can get you 5 times leverage, options can give you 500 times leverage. So if the leverage ratios are as worse off as 1.5 times your capital, if somebody put 10 crores and can take a exposure of 15 lakhs, 10 lakhs, you can take an exposure of 15 lakhs, then it will not be exciting. It will not have any meaningful shift from the derivative market to this strategy, even at a mass affluent level. That's point two. Point three, I personally think that a lot of asset management companies have shared strategies with the regulator. I'm very happy that it's bottom up rather than top down. So first, people are looking at ideas, but the regulator is looking at ideas and then forming a framework, which I think is unique and first of its kind. I'm very happy that it's bottom up rather than top down.
So let's get in an AMC view as well. Radhika, what is your take on this new product profile that has come by and something that stands out for you here?
So I've been very excited about it. I think for the reasons Feroz mentioned, but the fact is that the mutual fund platform now is a very operationally transparent, convenient platform, and the strategies are boxed into categories because they're meant for the retail consumer. Now to be able to leverage the same platform for slightly more nuanced strategies, for again a slightly more nuanced consumers is very good for the asset management company. I think it provides us tremendous operating leverage in terms of using the talent of our teams for some new ideas, and it provides consumers more options. I do think, however, the devil is in the details. So when the working paper came out, and there's been some very good consultation with industry, there were examples of strategies that were out there, potential ideas that were out there, and I think there are at least 2-3 interesting categories of ideas. For instance, the whole space of long short funds can be played in this category because you are allowed to take some amount of hedging that is not just direct hedging. You can do more work in the credit space because the funds don't have to be daily open-ended. So you can have restricted redemptions, then you can hold more illiquid fixed income. I don't know what you can do in the unlisted space. You can do some more concentrated equity portfolio, higher risk ones. The current board meeting had a very short note on new asset class. So again, I think it's very important to understand what is in the circular. There was interestingly one thing I did note though in the board meeting is they've said that no leverage will be allowed in this platform and hedging will be limited to 25% of the position. So you can't run, a very aggressive long short fund. You can probably run a fund that is 75 long, 25 short. So I think it will be limited in what we can offer, but we're very excited to see the details. Let's see the details.
Okay, so waiting for details for sure, but that's of course the first take and a lot more fine tuning will have to be done. It was such an interesting discussion. I'm definitely not done, but unfortunately we are completely out of time on this edition of MF Corner. Radhika and Feroz, always a pleasure to speak to the two of you, and this time for something so topical. So thank you so much for joining in and stay tuned for CNBC TV 18 for more news and updates.